thank you very much, Michael, for coming and joining us. We have a special guest. Michael Pento is with us. We're going to talk about what we see in the economy today. We are going to talk about what you can do for yourself. There's a couple of issues coming. Michael and I are both on the same page that maybe we have a recession. Could be an epic recession coming. We have some liquidity issues. We have higher interest rates. Michael, what is this going to look like coming at us, and how soon do you think this is going to come?
Yeah, thanks for having me on the program, Michael, and nice to meet you. So, I've been predicting a recession this year. It looks to me like probably the fall is the most likely time for the NBER to recognize that one has started. But for most intents and purposes, it's already begun. And, it's probably most significantly becoming manifest in the real estate market. If you look at something like pending home sales that was released just today, pending home sales for March year over year were down over 30%. So you definitely have, I would consider that almost, forget about a recession, almost a depression in the housing market. And if you look at the housing market in general, you had amazingly, in my mind, you had Jerome Powell buying mortgage-backed securities up until early 2022. Mm-hmm. So he started raising rates in March, but he was still expanding his balance sheet and buying mortgage-backed securities, lowering the cost of doing business to buy a house. And that helped, that kind of action, what actually was the expansion of his balance sheet by $4 trillion in 2 years following the pandemic. That sort of action helped bring borrowing costs to a record low and helped cause home prices to rise 20% year over year in the last 2 years before the start of this year. So if you look at things like home price to income ratios, much higher than they were even in 2005 was the previous bubble. So yes, nominal prices, if you look at the Case-Shiller Home Price Index, all-time record highs, shattering the old records that we had prior to the global financial crisis. But even if you take that as a percentage of the incomes, so household incomes, it's still ridiculously unprecedented bubble that we've created in the housing market, and it's going to deflate. And history shows us that bubbles don't deflate gracefully.
Well, we've already seen that. So you know that when you have a 30% decline in sales, right following that, you have a decline in actual price. We're starting to see that in some of the cities that are having trouble. San Francisco, of course, just got to be, if you want to talk about ridiculous prices and bubbles, I mean, they not only had a wage explosion, they also had a housing explosion. They are already down at 17%, I believe, is what Case-Shiller says, but I've seen some studies saying 33%. So if you bought a house for $2 million, even a 17% decline in 1 year, you've lost $350,000. And also, Michael, here's what we're seeing in the commercial world is that these cities like Chicago, I think, has become a failed city. People are going to be concerned to go to work, and I personally concerned about it becoming a failed city. Citadel has left Chicago, and they left for a very good reason. I think Chicago might go to way of Baltimore or Detroit, but you're seeing that in San Francisco. Vacancy is up 27% vacant in San Francisco. And here's one of the concerns we have, and I think this falls right into what you've been talking about, is that if you buy a building and it's got a $200,000 a year income for yourself, now it becomes vacant. And now instead of having $200,000, now it has $100,000. What's the value of that property?
So listen, you had the past few years when you took money, 10 out of the last 14 years to be precise, money was free, virtually free, below 1%. Fed funds rate was below 1%, effective Fed funds rate. And then you had these banks like is it First Republic right now, clinging to life because they made a bunch of loans to Wall Street that were interest-only mortgages. I mean, I thought this insane process was over, but now they have all these assets. Let's talk a little bit about the banking system. You have a banking system that has a lot of assets that were yielding almost nothing, because interest rates, mortgage interest rates were down to like 3%, low threes. And then you have principal that doesn't get repaid back. And that's that asset exists in the context of a world where you can get a risk-free treasury rate that yields 5%. So it's a simple calculation. Do I want a risk-free treasury that yields 5, or a broken loan that never gets its principal paid back and yields 3%? This is the insanity that we created from our central banks. 25% of all first-time home buyers were investors. Think like Blackstone and Wall Street over the past few years. 1/4 of homes purchased were for investment purchases. So there's a lot of demand that was artificial that's going to come out. I mean, you could buy a house as an investment and rent it out, and that looks really good on your balance sheet when your rents are going higher and the underlying principal goes up. But that investment makes no sense when the principal is going down, home prices are falling, and your renter doesn't pay you any rent because he loses his job. So that's the dynamic that's going to happen later this year as this recession intensifies.
Yeah, we're very, very concerned for some of the northern, I mean, if you're in Florida, Texas, and Arizona, it's a regional phenomenon. So you're probably nowhere near as bad as what you're going to be in Milwaukee or Minneapolis or New York. Certainly the California states, like what's going on in San Francisco. And when you get back to these mortgage back, when you talk about the banks, not only do they have credit risk because the asset itself is at risk with vacancy and, of course, in valuation, but now you've got a 3% asset in a 5% world. So now you've added, compounded this. So what would be the mark to market on an asset like that in a bank?
It's going to be a bit, wouldn't be par, right, Michael? I don't know what it would be. I mean, it have to be sometime, sometime soon, these assets are going to have to be marked down. And then when you have all these private equity firms that just could mark to model because they say, oh, this asset's trading at par, the first one that gets sold, and I think First Republic, when they have to dump some of these assets, they're going to realize their losses are, 50 cents on the dollar. I don't have the exact number for you, but it's nowhere near par because as I said, and as you repeated, who wants an asset that has a very high credit risk that never pays back its principal and is yielding below 200 basis points from its risk-free treasury rate? But this is just one of the issues of mortgage-backed securities in the banking system. What about credit cards? What about auto loans? What about commercial mortgage-backed securities? What about collateralized loan obligations? These high-risk loans that can't even tap the junk bond market. So you have a banking crisis. You have a shadow banking crisis. All these things are to become more manifest as we progress towards this recession.
Well, so we see a lot of risk. So we've been out of the marketplace since really March of 2022. We saw, once we peaked, we saw liquidity peak. We saw the fact, and yes, you're correct. I think it was until March of 2022 when the Federal Reserve was still buying $60 billion a month of mortgage-backed securities, and then they stopped. And as soon as they stopped, we felt it in the real estate market. It was like, it's like the Star Wars, the force shuddered, so we could feel that.
Michael, I mean, home prices had no business going up, many times over incomes and over inflation. It's all artificial. The Fed voted, they deemed it necessary to reflate asset bubbles. Look what happened in 2008. In the 3 years leading up to 2008, I look at leverage in the economy. Total public and private debt jumped by 27%, or by $7.3 trillion, all the way up to $33.5 trillion. So let's look at the situation today, the 3 years leading up today. Total debt jumped by 26%, it's almost the same, but it jumped by $14.4 trillion. And nominal debt soared all the way to $68.9 trillion. And if you look at debt, as a percentage of GDP, it's 263% of GDP. Prior to, so look at the end of 2007, total non-financial debt was 227% of GDP. So we have these debt crises. What is debt? The debt is taken out. It builds asset bubbles. We now have a concurrent and unprecedented asset bubble in stocks, bonds, and in real estate. The bond portion has started to break, thank God, because of the Fed. They finally got religion. But as these bond yields continue to rise, and we haven't seen anything yet on the junk bond arena yet. This is just
correct. $3 trillion, I think, Michael. Triple B.
Yeah. Well, triple B is going to become, that's still investment grade. You're going to get investment. You're going to get below investment grade.
Correct.
Fallen angels are going to be all junk. And then, certain institutions can't hold junk, so they have to sell those. That brings the prices down, the yields higher. We haven't even seen that yet. So these bank assets, which are all highly leveraged to the economy, and of course, I probably don't have to remind you about the fractional reserve system run on banks. There just isn't the money there if people want their money out. So go watch the movie It's a Wonderful Life. When you want your money out of a bank and you have to sell assets to make redemptions to meet liquidity requirements, you're in a big trouble. And I think we're headed in that direction again. Don't forget, I just want to say this. The Fed printed $400 billion in 2 weeks in early March.
They did.
And they did that as part of that, I call it QE Light, but it's the Bank Term Funding Program. If the Fed did not do that, we would have a replete Lehman Brothers-like collapse of the shadow banking system and many of these regional banks. Because what was happening in the banking system, Michael? You had a run on deposits. What was the run on deposits all about? Well, first of all, you had quantitative tightening happening, which was a drain of about $90 billion a month of reserves from the banking system.
Yeah.
Then on top of that, you had these assets, these loans starting to deteriorate because of the economy. And then on top of that, you had a treasury that yielded 5%. And because of the excess reserves in the banking system, a lot of these banks, all the way from JP Morgan to Silicon Valley Bank, they thought it was a great idea to say, I know that you, Mr. Depositor, would like some interest on your deposit. But since we have so much reserves parked at the Fed, earning interest on those reserves, we really aren't going to pay you squat on your deposit. So then everybody not everybody, but most people, I did it. And my calculation was, well, I can keep my money in my bank and earn nothing, or withdraw my bank and put it into a money market mutual fund, or a treasury only bank brokerage account, and earn 5%. It's a no-brainer. So you had those three huge drains on deposits, and when you have a drain on deposits, guess what? You just can't make as much loans as you used to make. And that's all the dynamic that has started since March. This is a new phenomenon. And I want to say, before I forget, I hope I didn't mention this already. But M2 money supply growth, if I did, I'm going to mention it again because it's so important. M2 money supply growth went from 27% in 2021 to minus 4% for the first time in history. And when you have money supply growth crash, that was a March figure, that minus. So if it's already crashing and it was a March figure, and this is before the banks, which are going to be much more highly regulated now than they were before. And this is before the recession really becomes manifest. So I would expect money supply growth to shrink pretty acutely here in the near future.
Well, when you said that the Federal Reserve put out $300 billion, that was at the same time that the $400 billion, Credit Suisse was going down. And of course, the Swiss National Bank had been to the Fed 2 weeks earlier because they needed liquidity for the National Bank of Switzerland. They came to the Fed and borrowed money from the Fed so that they could have some liquidity. And then 2 weeks later, they backstopped the Credit Suisse by $100 billion that they don't have. So part of that $300 billion or $400 billion bucks, had to go to Europe. Correct?
Well, yeah, the Fed has swap lines. Yeah, the Fed has swap lines.
Swap line. They did a credit swap, of course.
Yeah. So it's not surprising.
So it's not just here in the United States, Michael. This is international. I think Europe's even in worse trouble than we are here.
Europe? How about Japan? Japan has a 40-year high inflation rate, They're a insolvent nation. And their 10-year Treasury note yields 0.5%. That's the high watermark. And how do you get that? I mean, who would accept a half of 1% when inflation is over 4 and rising? And your currency is going down, going out 10 years in duration. Who would do that? Well, I'll tell you who would do that. Bank of Japan. That's
Of course.
That's the only entity that is participating in newly issued JGB auctions.
Correct.
Well, this is a global crisis. It stems from Europe, Japan, China, and to the United States. So yes, it is systemic, and it is global.
So when do you think we're going to start seeing this credit event, Michael? Do you have a time frame on this?
I mean, listen, I have a 20-point model that I created. It watches financial conditions assiduously. It watches credit spreads very closely. And I would have thought it would have happened already. But I think it was starting to happen before the Fed launched this BTFP. But the BTFP is not QE. It is a loan with interest that has to be paid back in a year. So this is not the same as the Fed saying, "Hey, I'm gonna print $85 billion a month, hand it to you, and guess what? I want you to take those reserves and buy more of what I'm gonna buy the next month." Now you have the banks front running this. This is not the same. This is troubled banks going to what is pretty much the same as a discount window, except they're getting par for their assets instead of really worth.
Yeah, so it's pretending.
Yeah, it's so. You can extend and pretend on these assets, and that's what they're doing. But you don't tell me that these banks that have tapped the BTFP are going to go out and make a bunch of crazy loans, no interest loans. No, not when they're. This is liquidity to keep them afloat until they have to pay the Fed back. So
of course
they become somewhat zombified. The regional banks have become zombified to a great extent.
Well, it puts a huge brake on the economy. Because the liquidity that used to be the fuel for the economy, I mean, there was money to do virtually anything crazy idea that you had money to do that. Now that money is no longer there. And of course, if you've only got $100 million, you're going to be very, very careful where you're going to put that $100 million. So the underwriters become very, very skeptical of everything that you do. Puts a huge brake on the economy. It's like having a 1 or 2 or 3% increase in the Fed fund rates. When the underwriters start saying no, Michael, that's a problem.
You go from March 0%, March of 22 to 5% by May, 5.25 perhaps even, low fives by May of 23, and the QT program is still continuing. So when you have that much of a rate of change in monetary tightening on top of a record amount of debt, on top of record asset bubbles, bonds, real estate, and equities. Don't forget, equities were the total value of the market as a percentage of the underlying economy reached 200% in 2000 and by the end of 2021 started. That in looking at history as a guide, that ratio should be around 80, not 200. You had 17 globally, $17 trillion worth of bonds that yielded less than zero. In other words, I borrowed money and got paid to do it. So you think about the bubble in real estate, all-time record high home price to income ratios, up 20% year after year. Think about the bond market and think about the equity market. And you have a triumvirate of bubbles sitting on a record amount of debt, meets and slams into record hawkishness that's not really voluntary. The Fed had no choice but to fight 40-year high inflation. The way they measured it was 9.1. The way I measured it was 17 to 20. They had no choice but to do it. And the ramification and monetary hikes work with a long and variable lag. Watch out for later this year. It's going to be a train wreck in my opinion.
Well, of course, we're just going to go to that. So we're talking a 9 to 15 month lag on the raising of the interest rates of the Fed fund rate, and we're just now getting to the point where we're just now feeling the very first interest rate increase. So what's that going to look like in 10 to 15, 18 months from now?
I don't think it's 10 from 15. I mean, normally you see the market top out and the economy top out about a year, but after rate hikes stop. But that's when you go from quarter point increments over the course of years. We didn't do that. We went by 70 basis point increments. We went from zero. Again, it's important to understand. We went from 0 to over 5% in a year. That has never happened before.
No, I know it's historical, and this lack of liquidity is historical as well. I mean, it's going to put a huge. It's interesting. I do a small model myself, and our timing model shows the third quarter of 2023 as really starting to see a waterfall on home prices itself. So it falls right in line with your thinking. So very interesting. And you bring up such a good point. What is the value of a negative yielding bond in a 5% world?
I don't know, but it has zero. Less than zero to me. You have to pay me to take that risk.
Correct. And these European countries, they made it a law that the pension funds had to buy 70-80% of these negative yielding bonds. So these pension funds, which are guaranteeing income for all the people my age, are basically broke.
Yes, it's absolutely. And you haven't seen that. You haven't seen it. You haven't seen the recession really become manifest. People are still talking about a soft landing. But look at the American GDP. We went from 3% in Q3 to 2 point something, I think it's 2.6% in Q4 22. Now we're 1.1%. We are falling. We are waxing towards recession here. And when you hit recession, you're going to have, and if we haven't hit there already, you're going to have a very deep recession as evidenced by the money supply growth contraction, by the inverted yield curve, by the leading economic indexes. All these things speak very clearly to me that in my model that we are headed for not only a recession, a deep recession, and that's when you get these bank assets really hit. You just can't. This is a new dynamic, Michael. Ever since 1987, when we had the stock market crash 23% in one day, Greenspan then lowered interest rates. It was very easy to do because inflation was killed by Paul Volcker in the early 80s. You had a 40-year decline in inflation. It's not so easy when you have this next deflationary depression, collapse of asset prices. It's just not going to be so simple for the Fed to go back to zero interest rate policies completely right away. It's just not going to happen. I think it's going to happen, but not right away. It's not going to be a reflex like it was with Ben Bernanke when he took rates to 0% right away. In 2008, I mean, he went down quickly from 5.25% to 0 by the end of 2008. Such a dynamic is not going to be as easily done because if you do that, you've inculcated then. You've taught by repetition, hey, I can never again fight inflation. So I think the next time inflation becomes a problem, and I think it will, it's not going to stop at 9. It's going to go well into the double digits, unfortunately.
Yeah, it's amazing, and I think Jerry Powell is a great fan of Paul Volcker. I think Jerry Powell thinks that Paul Volcker was an American hero. So listen, we're getting along here. Michael, I need to really do this. Is that what do you think the man on the street can do to save himself or to prepare for this? We have a little bit of time, but that time is very, very short. What do you think they can do? Give me some practical things that these guys can do.
First of all, I wouldn't be buying high beta equities right now. I wouldn't be going, gaga for NASDAQ stocks because, when you have a recession, usually earnings fall about 19 to 20%. That's for a normal recession. Deep recessions, they fall 35%. So you're going to see high beta equities tumble. I don't really do price targets, but it wouldn't surprise me to see the S&P down to 3,300 when this is all over, maybe even as low as 3,000. So you should cash out of high beta equities. Make sure that your deposits in the banking system are below the FDIC minimum, which is $250,000. Spread it out over different accounts. Have a lot of money. I have a lot of money in treasuries. I manage money for a living, so I manage my own fortune as the fortune of others too. We're highly concentrated in short duration treasuries. We have some gold. We have bond proxies. So think about low beta equities like utilities at the moment. And also we have the ability to short the market. Not primarily. We don't do direct shorts because we don't use margin options or leverage. We have a lot of retirement funds in my portfolio, in my group of investors. So we use occasionally inverse ETFs, but you got to get the timing right on that. But we also do straight shorts. So we buy ETFs that go up when the market goes down. The ETF itself doesn't, but not the daily inverse stuff, because that can get us in trouble.
That's sort of like a trade, I think, isn't it?
Say again, sorry.
The daily inverse. That's almost like a trade rather than.
Well, yeah, they're not intended to be used for long duration, because if you have a lot of volatility, you could see the way the math works. You just you could be right on the trade, right being that the market's going down, but lose money because of the daily resets. It's just the way the math works.
So it seems that now is the time to be a little bit cautious. I'll tell my clients, you don't have to be 100% invested 100% of the time.
Yes.
So,
good for you. Yeah, I mean, it's I can do that. I own my own RIA, so I have the ability to do that. But most of the wirehouses, the main, I call it the deep state of Wall Street. They have a vested interest. Just dollar cost average, buy. You can't time the market, blah blah blah. Yeah, well, maybe you can. But when you see a recession, when you see all of these things, when you see money supply crash and LEI index crashing, the National Federation of Independent Businesses, that index is crashing. When you see the yield curve inverted, I am going to go over my whole 20-point model. But when you see these things saying, "Hey, it's time to think about getting defensive," do so, because if you don't, you're going to lose, as the practice has been, 50% of your money in a recession goes down. So 50% reduction in your retirement is not what you want to do. And you want to do something also to save. You save the middle class is also one of the most important things of any country. You want to save the middle class as much as possible. So when their real incomes are falling, inflation is eroded, their purchasing power, their standard of living. These people are the bread and butter or the salt of the earth of the U.S. economy. They do most of the real work. And if you do anything to help them, what you really need to do is bring about stability in interest rates, asset prices, and inflation. And that's the opposite of what we have now. The opposite.
Correct. Yeah. Well, so let's recap this, Michael. So this is a time to be cautious. So maybe some short-term treasuries, and you would say like anywhere from a 30-day to 3 years. Would that be short-term? Would be beyond 3 years be too long?
So T-bills, yeah, I'm invested across the yield curve, so I have some duration too. I have long-term treasuries, but most of my money in the bond sleeve is in short duration, 0 to 3 month, and then I have some 1 to 3 year treasuries too.
Is there an allocation that you would think? So you're really short on a big portion of your portfolio then. So 30, 60, 90 days it'd be pretty long for you, I'm going to guess.
When you say long, you mean
long time.
Yeah, I have like I said, most of my money is in 3 year or less, and most of that is in short duration treasury.
And does anyone have any concerns about any of the major houses if they have their IRA or their Keogh account in any of the major houses? Do they have concern about getting their money? I don't want to name anybody, but you would know who I'd be talking about.
I mean, even though I clear through Charles Schwab, there's a lot of rumors about them having trouble. They have access to the BTFP. Most of their problems were treasuries. So if you think about Schwab, they could just take all their treasuries and bring them to the Fed. They get par value for their treasuries and hold on to them for a year. And I have no doubt that the Fed is going to roll that over if there's a serious problem with big investment houses. I mean, you bring down somebody like Schwab, you're talking about the entire U.S. financial system and economy into a depression like we've never seen before. So the Fed is going to do anything they can to save it. But that's why I measure, map, and model the changes in inflation and growth, because the second derivative of such, because I want to be short when I should be short, and then long the inflation when it comes. I think, again, the next time we have another turn of the cycle, inflation is going to blow the doors off of anything we've ever even imagined in this country was possible.
Michael, that's funny you say that because that's in our model as well. We see inflation coming, severe inflation, and which is kind of odd when we're looking at a recession. So it's going to be kind of a balancing act.
Different times. So first you have now we have disinflation, then you're going to have deflation and depression or recession. It's the change in fiscal and monetary policy that brings about inflation. Inflation doesn't happen by osmosis. If we were under a gold standard, there'd be no such thing as inflation. If you kept base money supply targeted to population growth plus productivity growth, so say around 1-2% per annum, which is pretty much what the mine supply increase of gold is. Well, guess what? You don't have any growth in base money supply, and if you don't grow the base money supply by $4 trillion in 2 years, you're not going to have runaway inflation like we had, intractable inflation. So you're going to see a change in fiscal and monetary policy. Janet Yellen used to be head of the Fed. Now she's Treasuries. I can imagine her and Powell doing a powwow after this recession becomes full blown and manifests and saying, hey, that little thing called helicopter money that worked really good? It turned stock prices around, and it turned the banking system around, and it turned real estate prices around. Let's try that again, because that worked really well.
Well, if only someone could have known that if you put $4 trillion into the economy that you'd have inflation. If only someone would have known.
Yeah. If someone only would have told them that if only they opened up the history book and looked at every single hyperinflationary battle and since the dawn of fiat currencies, you'll see that it always comes from when a central bank monetizes debt.
It's crazy. Okay, so they need to be careful, get their money into some treasuries, some short-term duration treasuries. I'm sure that they need to really watch their credit, get your credit and your debt under control if you possibly can. Imagine pay down credit cards, build a cash reserve. Nothing wrong with that at all. How about cash at home? A good idea to have some cash at home.
Yeah, you should always have a few months liquidity, operating liquidity, absolutely. And I would say don't pay down your debt. If you have a fixed rate of interest that's very low, then I wouldn't pay that down. But if you have a variable rate interest that's high and rising, then you have to pay that down. That's to destroy you. When you have very high inflation and you have a fixed, you locked in a mortgage of say you have a 3.5% mortgage that's fixed. I can get 5% in the Treasury, or I can get pay 3%. That's a great carry trade for me.
Yeah, that's a really good point. Having a 3 or 3.5% fixed asset on your home is a really nice thing to have. I was thinking more like credit cards and auto loans and things like that not only depreciate, the asset depreciates, but
credit cards should be paid off. Credit cards are an interest-free loan. That's all they are.
I didn't understand it, Michael.
Credit cards should be an interest-free loan. That's how you should treat a credit card.
Right. Yeah, yes. Very, very good point.
Yeah.
So this is the time to really talk to an advisor, get your, maybe they talk to you, Michael, we'll put you on there and they can look at their portfolios, see what kind of exposure they have and see what's suitable for them. We're going to put your contact information. Is there anything else that you'd like to bring up along this? And what's the best way for them to reach you, Michael?
So the website is pentoport.com. My email is mpento@pentoport.com, and the number is 732-772-9500 is the phone number for the office. And if you have $100,000 to invest and you are a U.S. citizen, give us a call to see if you fit for our portfolio.
Well, Michael, we could do this virtually all day long because there is so much to talk about. It's just like we get something absolutely every single day. I want to thank you so very much for this. And I'm going to say goodbye. If there's any other issues, let us know. But thank you so very much for joining us today.
Pleasure to meet you and to be on your program, Michael.
Thanks, Michael. Bye-bye now.